Hi, it's Alfred giving you an update on select income. We hope you're doing well. There's some bad news for fixed income investors. Even though government bonds have lost money for the first 6 months of the year, they are still expensive. They currently yield about 136 versus our estimated fair value of 205. That means if we are right, government bonds could potentially lose 6%. It doesn't sound like a lot, but however, compared to the 1.36 current yield, which is the upside, that 6% loss is actually significant. And when you compare to inflation of 2 or 2.5%, 136 obviously doesn't cover inflation. The good news is, in select income, we are flexible with our asset mix and we are active with our asset mix. Last year, we held as much as 20% cash when we felt the markets were very uncertain. So when central banks were printing money, put interest rate to zero, we start to deploy money into investment grade bonds because we feel that there was enough yield to cushion the risk that we are taking. And when the first vaccine was announced in November, we start to reduce government bonds, we start to reduce cash further, and we bought a lot of high yield bonds and we bought a lot of equity because we believe that reopening and economic boom is actually going to be ahead of us. So that positioning helps us with weathering the sell-off in fixed income since November. And you're going to ask me, am I worried about the valuations of the equity markets? And I can tell you I'm not too worried because we are in the early phase of recovery. And when you look at earnings, which is important, earnings been increasing. And now the S&P 500 earnings, for example, has already surpassed the earnings prior to COVID. So we feel confident about the markets because the markets are supported by growing earnings. Thank you for listening, and we look forward to update you again in the future.